Hey everyone, welcome back to the channel. So this is going to be a video series all explaining options for beginners. I'm going to be going over what options are along with the Greeks. We'll be going what a call and a put is, how to sell a cash secured put, and how to sell a covered call, and how to sell a poor man's covered call, and also if you need to adjust your positions, how to roll a covered call or a cash secured put. Again, this video is strictly for beginners. I'm going to be making a more advanced options video in the future. If you like this type of video, hit the like and subscribe button down below. I would greatly appreciate it. Let's get into the video. Hey everyone, my name is Tim. Welcome back to the channel. If you're interested in diving into the world of options trading, particularly selling options, you're in the right place. In today's video, we're going to break down exactly how to sell options, what implied volatility is, how to understand bid and ask prices, and we'll touch on the Greeks, key factors that affect your options trades. Let's jump right into it. First things first, let's quickly cover what it means to sell options. Selling options, also known as writing an option or writing a contract, involves you agreeing to take on the obligation to buy or sell 100 shares of an underlying stock at a specific price if it expires in the money on the expiration date when the stock market closes. There are certain circumstances that the buyer of the contract can exercise early, but that's rare. I've only had that happen once or twice. When you sell a call option, you're agreeing to sell 100 shares of stock at the strike price if it expires in the money on expiration date. Conversely, when you sell a put option, you're agreeing to buy 100 shares at the strike price if it expires in the money on expiration date. As the seller, you receive a premium for taking on this obligation, but you're also exposed to potential losses if the market moves against you. So selling options is often considered a more advanced strategy. Now let's talk about implied volatility. Here on Robinhood, that's right here. It just says implied volatility, and this is a big one to understand when you're selling options because it directly affects how expensive the options are. Implied volatility, or IV, is essentially the market's expectation of how much the price of the stock will move in the future. Higher implied volatility means that the market expects larger price swings, and as a result, options premiums are higher. Lower implied volatility suggests the smaller price movements, leading to cheaper options. For option sellers, selling options during periods of high implied volatility can be beneficial, as the premiums you collect are higher. However, this does come with a risk. If the volatility spikes even more after you sell the option, the price of the option could increase and you might face potential losses. As an example, if I were to sell this Verizon put at 41 cents per share and the implied volatility went up, that means that the option price would go up, and if it goes up too much, I would take a loss if I tried to buy this option back on the expiration date or anytime between then. So that is something to keep in mind. As a general rule of thumb, many traders do prefer to sell options when implied volatility is higher, since the premiums they receive is higher. But it's crucial to manage your risk and understand the implications of volatility on the strategy. Now, the next most important part is the bid and ask prices that you see here on Robinhood, which are again on any brokerage. They just might look different than Robinhood's, but I'm just showing it because it's easy to see on Robinhood. These are essential to understanding when and at what price you will actually execute your options trades. The bid price is the highest price a buyer is willing to pay for an option, and the ask price is the lowest price a seller is willing to accept for that same option. The spread between the bid and ask prices represents the difference between supply and demand. A narrower spread means that there's more liquidity, and liquidity just means that there's more volume, more people trading that option in the market. And a wider spread could indicate less activity or interest in that particular option. When you sell options, you're essentially asking for the bid price because you're the one providing the option for sale. Ideally, you want to sell your options when the spread is tighter, and I typically don't sell exactly for the bid. I try to sell in the middle of the bid and ask price but I'm willing to possibly not get my option order filled in that situation. A good rule of thumb is to look for options with a tight spread, as this typically means there's plenty of trading volume and that you won't lose too much money on slippage when entering your position. Alright, now let's talk about the Greeks. These are the factors that determine how much an option's price will move in response to changes in the various market conditions. The main Greeks are delta, gamma, theta, vega, and rho. You see them right here at the bottom of the options chain when I was looking at this option on Robinhood. So delta measures how much the price of the option will change for a $1 move in the price of the underlying stock. That means $1 up, $1 down. A high delta means that the option price will be more sensitive to change in the stock price. As an example, if I were to sell this option, that means that if the stock price went up or down $1, that the premium would go up or down by 33 cents. Keep that in mind, that the delta is also a good indicator for many option traders about the probability of their profit. So for instance, delta is basically taking this number subtracted from 100. So in this particular case, there would be a 67% chance that this option would stay out of the money and I wouldn't have to buy the shares and I'd get to keep the premium. That's not what it's officially used for, but that is what a lot of traders use it for. Gamma is the rate of change of delta. It shows how much delta would change if the stock moves. It's crucial to understanding how the delta will behave as the stock moves. For instance, in like the prior example, if the stock price goes up or down $1, like the delta will affect the premium, but then the gamma will affect the delta. So the premium will go up or down to either 74 cents or to 8 cents, and the gamma will change the delta to either 51 or down to 15. So that's how gamma would affect the delta if the stock price moves up or down $1. Theta represents time decay. This is especially important for options traders. As time passes, the value of an option tends to decay, and theta shows you how much value is lost per day. The closer the option gets to expiration, the faster it decays. For me personally, I tend to sell weekly options, so theta isn't as big of a deal for me, but if you sell longer time frames, 30 to 45 days, theta is a good indicator of how much of the value of the option will decrease each day. In this particular case, theta is saying that if I were to sell this option, every day the value of the option would go down by 9 cents. Vega measures the sensitivity of an option's price to changes in the implied volatility. If the implied volatility increases, Vega tells you how much the price of the option will increase. And Rho is it measures the sensitivity of the option's price to changes in interest rates. It's far less important for short-term trades, but can be more relevant in changing macroeconomic environment, i.e. long-term trades. As a seller, you're generally hoping that theta works in your favor, because as time passes, the options you've sold lose value. Ideally, you want the underlying asset, i.e. the stock, to move less and for implied volatility to decrease, so you can buy back the option at a lower price and lock in your profit. To sum it up, when you're selling options, you're looking to collect premiums while managing risk. Here's what to keep in mind. Implied volatility can affect how much premium you collect. The higher the volatility, the higher the premium, the higher the risk. Understand the bid and ask prices to ensure that you're getting a fair deal when you're entering and exiting your trades. Again, I try to go middle of the road of the bid and ask prices to try to get a fair price. If you're trying to sell your option quickly and get it filled almost instantly, then sell it at the bid price. Pay attention to the Greeks, especially theta, because that'll help you understand how your options will behave over time and as market conditions change. Selling options can be profitable, but it's essential to understand the risk involved and to have a solid risk management plan in place. My risk management plan personally, and I'm not a financial advisor, but I suggest if you want to sell options to usually choose Establish companies that pay dividends. Just that way, if the market moves against you, if the stock price drops suddenly due to news or new laws or anything, you can wait it out patiently and you'll still collect dividends every 3 months or every month, depending on what stock you have, and it will help lower your break even and help bring in income. You do not want to sell a call after you purchase the price above the price that you've purchased them at. You don't want to lose money. You don't want to lose the premium that you've received. If you're into options trading, then you know that they can be a powerful strategy. If you're new to options trading, I'm hoping that my video series will help show you how it can be a consistent way to have your money start to work for you and to, over time, grow your account size. But like with any trading strategy, it's easy to make mistakes, especially when it comes to selling and buying options. In today's video, we're going to talk about the most common mistakes when selling options, and most importantly, how you can avoid them. By the end of this video, you'll be equipped with some practical tips to improve your trading. So hit that like button, subscribe, and let's dive in. The first and the biggest mistake I see a lot of traders make, both new and old, is panicking, not having any patience. So if you're selling a put or selling a call and the market goes against you and the option goes up in price to where you have to spend a lot of money to buy it back or possibly get it signed, then a lot of people will panic, especially with selling puts. They'll panic because they don't want to own the stock, but then that's selling options the wrong way. If you don't want to own the stock, you shouldn't be selling the put on that stock to begin with. The best way is just to be patient. So if you want to avoid the mistake to where you're losing a lot of money, just be patient. This last week, I sold a put on a stock with the ticker symbol MU, and it looked like on Wednesday it was going to be assigned more than likely at the end of the week because it was dipping lower and lower. And I didn't panic. I just was patient and I waited it out. And by the time Friday came around, it had gone back up in price. So it was no longer close to being in the money and it expired worthless. So I got to keep all the money instead of spending $250 to buy it back Wednesday if I had panicked. So if you want to sell options for money, the best tip I can give you is do not panic and be patient. Another mistake I see traders make a lot is not paying attention to a company's earnings date, like the earnings news, and also they don't pay attention if the company offers a dividend to what date that the dividend is going to be paid out, because those events will affect the stock price on the days that they happen. Earnings could be very volatile. It could go up or down in wild swings depending on the company news for their earnings for that quarter. And for the dividend, whenever a company pays a dividend, the stock price will drop by the amount of the dividend because it's basically coming out of the stock price. And then typically the stock will either rebound or continue falling depending on how investors are reacting to that stock at that particular time. So if you're not paying attention to these two events and you're selling calls or puts, you could find yourself unexpectedly in the money in either the put or the call, or you could, going your way, it could actually increase your profits fairly quickly since you're able to buy back your call or a put a lot cheaper if the market goes your way. But it's a risk, and definitely for beginning investors, I don't suggest taking that risk. I would suggest waiting till the week after earnings or at least a day after the dividend payment in order to see how the stock is going to stabilize. The third mistake I see is trading options, selling options specifically without a clear exit plan. So when you sell options, it's easy to get caught up in the moment and forget to plan for the what ifs. If the market moves against you, having no exit strategy can turn a small loss into a big one. For example, if you sell a covered call and the stock starts rallying past your strike price, it's important to know when you'll close that trade or adjust your position. Otherwise, you could miss out on profits or end up losing money if the stock continues to rise. So how to avoid this mistake is always set clear exit points when you enter a trade. This could be a profit target or stop loss. You can also consider adjusting your position by rolling your option. By rolling your option, I mean buying it back and selling another date in the future, either up or down in strike price. And that way you can collect premium still, but you're not exposed to the risk if that's really what you choose to do. I personally like getting my puts assigned because I want to own the shares. I want to be able to sell calls because that's where the majority of the premium I collect is. But if you're new, I would suggest doing as much research as you can on how to manage your risk when you're selling options. Like I said, just don't panic, be patient, have an exit plan, and realize that you can roll an option if you need to. You can simply let it be assigned, or you can hope that the stock will reverse and it will expire out of the money. So those are 3 options right there that you can choose. The next mistake is ignoring implied volatility, or IV. It is a mistake that can make a huge difference in your profitability when selling options. IV measures how much the market expects the price of the underlying stock to move. If IV is high, options premiums are expensive and you'll get paid more, but there'll be more risk. And if it's low, you get less premium for less risk. So for instance, let's say you sell a put when IV is high. You're getting a nice premium, but the stock could experience sharp price movements, increasing your risk. On the other hand, if IV is low and you sell options, you're collecting less premiums, but you're also exposed to less risk due to the smaller price movements. How to avoid this? Always keep an eye on IV before selling options. If IV is unusually high, consider selling options that are further out of the money to reduce risk. And if IV is low, you might not want to sell the option at all because your premium may not be worth the risk. Another mistake is selling options that are too close to expiration. Selling options with little time left until expiration can work out if the stock doesn't move very much, but it can turn against you very quickly if the stock suddenly, due to news or new law or anything at all that could happen in the market, and it turns against you, you could lose money quickly. I like selling weekly options, so for instance, for me, selling an option that's too close to expiration would be if I were, for instance, to sell a put or a call on a Wednesday or a Thursday that's expiring that Friday. The premium just isn't worth it for me. When I sell a put or a call, I am trying to earn 30% annualized return on investment. So what that means is if I take the amount of money I have set for collateral for my cash secured puts, and since I do weekly options, if I take that over the course of a year, the premium I receive needs to be able to have equaled 30% of that capital that I use for the cash secured puts. And selling 1 or 2 days of a option, it doesn't give you enough premium really to risk it, unless you're trying to buy more shares or sell shares. Then I could possibly see that. Common mistake that I see a lot of traders do is not having a diversified portfolio. If you're constantly selling options on the same stocks, you're exposing yourself to more risk. Market conditions can change quickly, and if you're concentrated on just a few positions, a sudden market shift could hurt you drastically. For example, if you're selling options only on tech stocks and there's a tech sector correction, your positions could all be affected at once. It's better to diversify into different sectors or asset classes that can reduce the overall risk in your portfolio. The best way to avoid this is to diversify. So the last tip I have for you today is you need to practice. Before you ever start trading options with real money, you need to do paper trading. Anywhere from 40 to 100 trades. And it doesn't matter if that takes you 3 months, 6 months, a year. You need to practice. This is going to be a skill. It's not something you're going to get right every single time. So this way you can practice without losing any of your real money. Just put real money into your brokerage account or your Roth IRA, whatever you want, but do not use it until you do a lot of practicing on a paper trading account. It will save you so much money and so much time in the long run. Just practice. To wrap things up, selling options can be a fantastic way to generate income, but it's important to be aware of the common mistakes and how to avoid them. By understanding the risk, setting clear exit plans, keeping an eye on volatility, diversifying your trades, you'll be in a much better position to succeed. This is going to be a beginner video on how to analyze an options chain. So if you're already well versed in options, feel free to go and check out one of my other videos. If you're new or you've only just done a little bit of research, you probably heard the term options chain tossed around, but do you know how to read and analyze it? Well, in today's video, we're diving deep into the world of options chains, breaking it all down so you can confidently use them in your trading strategy. Before we jump in, make sure to like, comment, and subscribe if you're enjoying this content, and hit that bell so you never miss an update. Alright, let's get started. First things first, what exactly is an options chain? Simply put, an options chain is a list of all available options for a specific stock or asset, showing both the call and put options. It gives you details about strike prices, expiration dates, and premiums, and is essential for making informed options trades. And it is the only way to do options trades on most platforms. In this example, we have an options chain for the stock Apple. You'll notice a few key columns. Don't worry, we'll go over each one. So let's break down the key components of an options chain. The most important for any options chain is going to be the expiration date. Options are contracts. They can have weekly or monthly options available depending on the company. Some companies only have monthly, some do weekly. You can choose whichever you prefer, but the contract will expire when the stock market closes on that Friday. So it's always going to expire on a Friday, and you need to know that in order to determine what kind of options you want to trade and also what kind of time length that you're looking at. Next is going to be the strike price. That's the left column here. So this is the price that you're going to be willing to either buy or sell shares depending on which options you choose. And I'll be going over that in a minute. So with options, there are two options that you can do. Well, technically four. You have calls and puts, which is the two that you can do, but you can buy or sell calls or puts. So you have four options, but only two subsets that you can do. So, and it all depends on what you're looking to do. So if you're wanting to buy shares but get paid for it, you would sell a put. If you have 100 shares and you want to get paid for it and you want to sell them, or possibly sell them, you would sell a call. If you think the stock is going to go up, but you're willing to sell for possibly a higher price, then you would buy a call. If you're thinking the stock is going to go down, but you're willing to buy at a certain price, you would buy a put. Next is the premiums. You see these here on the right side, where the plus sign is, so you can choose that contract. The premium is how much you either pay to get into the contract or how much you get paid to get into the contract. If you are buying a call or a put, you have to pay the seller, and if you are the seller, you get paid in order to take on that contract. Next is implied volatility. This determines basically how much the market expects the stock price to move within the time frame of the expiration date. So the lower the implied volatility, the more stable the price the market expects it to be. And that also affects the premium price. The more volatile, the higher the premium, but the more risk of it going against you. And next is the open interest and the volume. So the open interest shows how many options contracts are currently open, so not yet exercised or expired, and volume shows how many contracts were traded that day. High volume and high open interest indicate a lot of people are trading this, so there's a lot of liquidity, which is what it's called in the markets, where you can easily buy or sell options on a given day. Now let's look at calls and puts more closely. As I mentioned, when you are betting that the stock is going to go up, that's when you would buy a call option. So for example, with Apple, right now the current stock price is as $245.83. If you believe in the next week it's going to go up, you can buy a call, and then if it does go up like you believe, you can sell it before the expiration date for a profit. Just be aware, the closer it gets to the expiration date, the more that the option is going to lose value. If you believe the stock is going to go down, you would buy a put, and the same applies. You hope that the stock goes down, you can sell it back for a profit. Now, if you are thinking that the stock is going to go up or maybe stay in the middle, you can do several advanced ones, but just for a beginner's sake, that's when I would sell a put, just to, more specifically, a cash secured put. I want to make that clear. You do not want to sell any naked calls or naked puts. That's basically when you do not have the money in your account to purchase 100 shares if you sell a put, or if you don't have 100 shares to sell if you sell a call. Never do that. Like, you will at some point lose, and you will lose big, because there's an unlimited amount of money you can lose that way. So stick to cash secured puts, covered calls, which I will go into in another video, and just buying options based on if you think the stock will go up or down. But don't do anything with selling naked options. Now, if you, like I said, if you want to purchase the stock but you want to get paid for it, you would sell a put. Now, if you already have 100 shares and you want to make weekly or monthly income, you can sell calls at a strike price that you like with the amount of money in the premium that you would like to get paid, and that way you get paid. Now I'm going to go over, if you hear the term in the money, out of the money, or at the money, I'll be going over those terms in this section of the video. So for specifically calls, out of the money is anything that's above the share price, like more than 1 or 2 strike prices away. So 247.50 would still be considered at the money because it's the closest one to it. So technically the 245 is closer price wise. That would already be basically in the money. So that's why this one's considered at the money, and the 250 and above would be considered out of the money. At the money is exactly what it sounds like. It's the options closest to the current strike price. And then for in the money, that's the opposite for calls. So 240, 250 and down, these are all in the money. So if you were to buy a call on these, they're far more expensive, and it would take a lot more for you to make a profit. If you were to sell a call, it's almost guaranteed that you would have to sell your shares at that price. So that's why you get paid more, because it's expected to stay above the price that it's at now, usually. And the same goes for the puts. So here in the puts section, this is actually considered at the money also, like the 2 closest strike prices. But then it's a little bit different with puts. So up here is considered out of the money. So anything 250 and higher is considered out of the money with puts, and the 240, 250 and below is considered in the money. So now I'm going to go a little bit more in depth to show you just the differences in volume and open interest between 2 different stocks. That way you can see what I was talking about as far as liquidity. So the stock here, Apple, it has a volume of 62,000. So that's how many contracts were traded on the last day that the stock market was open. Open interest is how many contracts are already currently open. That's the ones that haven't been exercised in some way and they haven't expired yet. So that's a lot of open interest, and that's a lot of volume, and that's daily. Now if we go to another company like AG&C, which is a REIT company, you can see here when you go to the options chain that it has much less. So same expiration date, February 5th. The $11.50 call has 0 volume and 0 open interest. So chances are you would not be able to trade this option. So next I'm going to be talking about implied volatility. You'll be able to see it on this chart here. And you can see right now that this option has an implied volatility of 44.98% for AG&C. So that's okay. And now let's go back to Apple. And we'll look to see what that implied volatility is. So going to this options chain, wait for it to load. So this options chain right now at this particular part has a implied volatility of 25.15%. So that means the market for this upcoming week doesn't expect that the price of Apple is going to change very much, which does affect the premium. The higher the implied volatility, the higher the premium. So if you are buying a call or a put on a stock that has a high implied volatility, you are going to pay more than you would if it had a lower implied volatility. And if you are selling a call or a put, you're going to get paid more for stocks with a higher implied volatility than a lower. So you see this one here. Let's check out one more company that I know has a very high implied volatility for this upcoming week because of earnings that are coming up for this company. So you can see here the option for at the money for HIMS is $605. So $6.05 premium, but contracts and options are 100 shares. So you multiply the 605 by 100, you get $605. So that's how much you would have to pay to buy this call. Now, if you were going to sell a call, you would instead get paid $585 because the implied volatility on this stock is 269%. So the market, due to earnings, expect this stock's price to fluctuate a lot after the earnings on Monday after the stock market closes. So the higher the implied volatility, the more money that you either pay or get paid. Okay, so you're probably wondering, how do I use this information to make a good trading decision? Here's where your analysis can come in. If you believe that the stock price is going to go up, you can buy a call. For instance, here on Apple, if you believe the stock will go up, you can buy a call for $63. And this chart here from Robinhood shows you that you will make profit if the stock price goes above $253.13. That is the strike price with the price that you paid added to it. So anything above that and you'll start making profit. If it does not go above that, you lose the $63 that you paid. So there is that. Keep that in mind, that you can lose money if it doesn't move the way you want it to. Now, if you are thinking that the stock is going to go down in price, you can do the opposite. You can buy a put. And let's take a look at this one here at $242.50. So you would pay $180. And in this case, the break even, or the strike price plus the premium, means that it would need to go down to at least $240.70, and then you would start making profit. And then if you're interested in doing some more advanced strategies like the wheel, it's still fairly basic, but in those cases, instead of buying, you're selling. So you would sell a put and then you get paid, and then if the stock price goes below the strike price but on expiration, then you have to buy 100 shares, and then you can start doing covered calls to get paid. But also don't forget that the options expiration isn't limited to just a week or a month. Like, you can go really far out. So for instance, buying a call, let's say you believe that the stock price will go up, but you're not sure exactly how long, you can go 40 days out. Just keep in mind that this does increase a premium. So You could pay $231 if you believe in the next 40 days that the stock price is going to go above $262.31. And you can even go further than that. Like Robinhood and most brokerages let you go over a year or two. So for instance, this one here for 390 days, you could buy a call and you pay $1,880, but it doesn't expire until March 20th of 2026. So here your break even would be $288.80. That's what it would have to move above before you start making profit, but it has a whole year pretty much before that expires, so it has more time. And the same thing happens if you want to buy a put. You have more time and you can make more money if the stock price goes the way you think it does over that long time frame. And that's a wrap for today's video on how to read and analyze an options chain. We covered a lot of ground, but don't worry, with practice, and I do recommend paper trading to practice to begin with, this will start to feel like second nature. To recap, focus on the expiration date. Focus on the strike price that you're wanting to buy or sell your options at. Focus on the premiums, how much you have to pay or how much you will get paid. The implied volatility, which will affect how much the premium is. The liquidity of the option, so how much open interest and how much volume is the stock trading for. Use that information to make strategic options trading decisions using your market outlook. If you're new here, my name is Tim, and today we're going to go into my favorite strategy when it comes to options, and it's very popular among other options traders too, and that is the wheel strategy. Whether you're just getting started with options or you're looking for a simple yet effective strategy to make consistent income, the wheel is a great place to begin. Stick around as we break it all down step by step and get you ready to start making smarter trades and consistent income and grow your accounts. So the wheel strategy is a method that involves selling options to generate income. It's called the wheel because it follows a circular process of 3 main steps. Here's how it works. So the first step in the wheel is selling a cash secured put. This means you're selling a put option on a stock you like or would be willing to own. You choose the strike price, which is also the stock price that you would be willing to buy the stock at, and you sell the put option to someone else, the buyer of the option. In exchange, you collect a premium, which is the price someone else is willing to pay for that option. For example, if you were looking at AMD as an option for the wheel for you, on the expiring this Friday, if you were to sell a 98 strike price put option, that means you'd be willing to buy 100 shares of AMD at $98, and you would be paid $152 for that options contract. I know it says $1.52 here, but a contract is 100 shares, so you multiply this by 100, so you get $152. But the key word here is cash secured. You need to have enough cash in your account to buy the stock if the price goes below your strike price. In other words, you're saying, I'll buy this stock if the price drops below this point. In this example, you would have to have enough money in your account to buy 100 shares of AMD at $98 per share, so you would need $9,800 as cash for the collateral. Step 2. Now if the stock price falls below your strike price, the buyer of your put option will likely exercise their option. It's not always a guarantee, but they are likely to exercise their option and you will be assigned the stock. By assign the stock, that means you are buying the stock. So you have to buy the stock at the strike price, but remember you already collected the premium up front, so your effective purchase price is actually a bit lower. So your cost basis, or the total amount that you technically paid for the shares, would be the $98 minus the $1.52 per share that you received for the contract bringing your cost basis to $96.48 per share. Now, if you end up owning the stock, that's okay. The goal here is to own the stock that you like at a discounted price. Once you own the stock, the next step is to sell a covered call. A covered call is when you sell a call option on the stock you just bought. You're essentially saying, I'll sell you my stock at this price if it goes above this level by this date or the expiration date. Again, using AMD as an example for this upcoming Friday. So for an example using AMD, let's say I had purchased 100 shares at $100 and weeks previously, I wanted to sell a covered call. I could do it either at my cost basis of $100 per share, or I could even go to a little bit higher, like 101. So I get more profit if the stock price rises above that. But we'll use 101 as an example just to make it easy. So in this case, I would be paid $217 to sell a call option where I'm saying I'd be willing to sell my shares for $101 per share if the stock price goes above 101 by the stock market close on expiration date. Now, the last step is to get those shares called away and repeat the process. So once your shares, after you sell a covered call, get sold, you start the whole process again by selling a cash secure put either on this same stock, or you can choose a different stock, whichever one you choose. As a tip for any beginners, I suggest looking for dividend paying stocks that have weekly options preferable. Just that way you can have weekly income, and if for some reason you aren't able to sell covered calls after you get assigned, say because the stock price drops significantly, then you can simply wait and you will still collect dividends every month or every quarter, depending on the stock's dividend schedule. So now let's talk about the advantages of doing a wheel strategy. So why would you want to use the wheel strategy? Well, there are a few key advantages. You're generating consistent income. By selling options, you're collecting premiums regularly for both selling puts and selling covered calls, which can provide a steady income stream. It is lower risk than other strategies, since you're either selling cash secure puts on stocks you'd want to own or selling covered calls on stocks you already own. The strategy is far less risky compared to buying calls. You have increased flexibility. You have multiple ways to win. You can keep the premium from the options you sell, and you can either not buy or have to sell your shares, or you can get the premium and you still get to own a stock at a discount and potentially make a profit on a covered call if you sell above your cost basis. So you can make money in all four steps of the wheel strategy. And the last advantage is it's ideal for range bound stocks. It works on stocks that are relatively stable. You're betting that they won't experience a big price swing. If you can pick the right stocks, it becomes a consistent income generator. Now, there are some risks to selling the wheel strategy, but it's not as big a risk as a lot of people on the internet will tell you. One risk is being assigned the stock and then having the stock drop significantly. And that can be mitigated in several ways. I've had that happen to me on one of my wheel strategies with Kohl's. Basically, it just fell significantly. I had originally sold a put at $19.50 and now it's at 12 something, which means right now I can't sell covered calls. But what I do is not only will I collect dividends because it is a dividend paying stock, but I've actually sold 2 more puts. And I know what you're thinking, that sounds counterintuitive. Why would I sell puts on a stock that's consistently right now dropping in price? And the reason is to lower my cost basis. So I'm collecting premium for selling the option, and also when I get assigned, it's at a lower price than my original, so it lowers my average price of how much I bought the stocks for, which means eventually I will be able to sell covered calls again. As an example, right now I have 500 shares, and right now I did collect $250 on my last call option for 5 contracts. And if they don't get called away come the ex-dividend date, I will collect $250 in dividends also this quarter. Another risk is missing out on big gains if the stock price has a big shoot up. So if you're selling a covered call and it typically it's fairly stable, but then all of a sudden some great news happens or a new law changes or something else causes the stock to have a meteoric rise, then you are under contract to sell your shares at the strike price you chose. So it could go 10, 20, 30 or more dollars higher if that were to happen, and you wouldn't be able to realize any of those profits. And the last one, which sometimes holds people back, is this old saying that it takes money to make money. In this case, it is very true. You have to have the cash in order to do the cash secured put in your account in order to start the wheel. You can't start at $100 or $200. You have to have a significant amount, several $1,000s sometimes, before you can start trading the wheel. But once you do start collecting the wheel, you can start generating that consistent income. So to wrap things up, the wheel strategy is a great way to generate passive income by selling options, especially for beginners. It's a relatively low risk strategy, and as long as you pick the right stocks, remember it is not a get rich quick scheme and it requires some patience and practice. That's why in all my videos I say before you do any of these option strategies, do paper trading. Just that way you can get used to how your interface looks or how the options chain looks. But if you're consistent with the wheel, it can definitely work in your favor. And today I'm going to be talking about how to roll options for fun and profit like a pro. So there is going to be the occasion several times when you're doing options trading that you will need to either roll or you just accept the fact that you're going to get assigned or have your shares called away. There's also a chance it's going to expire worthless, which is the end goal of when we trade options. That way we can keep all the premium and get all the benefits, but sometimes that's not possible. That's why it's important to trade a stock that you don't mind owning. That way, if you do sell a put and it gets assigned, you are fine with it. And it's also important to try to do this with value stocks. Right now, I'm doing the wheel trades and stuff on a growth stock, i.e. Riot blockchain, which is tied somewhat to Bitcoin. So when Bitcoin drops significantly, so does Riot, and when it goes up significantly, Riot does too, but not in the same exact manner that Bitcoin does. That's more Marathon Digital is more in line with the actual movement of Bitcoin. So you can do either one of those if you're interested, but I do recommend doing value stocks rather than growth stocks. So in this case, it's more of a do what I recommend as for stock choices and not what I do. I just happen to like the premium. I believe in the companies and I believe that eventually they will recover. Just like I also believe Bitcoin will eventually have a more mainstream use than it does currently, rather than just saving it against inflation, especially since it's so volatile. But there is a way to make consistent income with value stocks weekly, and there is going to be a time, like if a price drops significantly and you need to roll it out so that way you don't get called away prematurely before it can possibly rise again, then you'll want to roll your option. And so I can show you how to do that. I'm going to start off in Robinhood since that's the account I'm using right now to help out my father. So he gave me a certain amount of money to invest for him, and this is the stock I'm investing in, and I've actually made him quite a bit of profit this year. Well, not 2022, but in 2021. I'm working on it in 2022. It's in project mode. So right now I do keep a close eye on it. And now I'll show you how to go ahead and roll an option, because I am most likely going to have to roll one of my call options tomorrow. I may not have to, but I probably will. So I'll show you my plan for that. And I'll also show you my other plan for the put that I have for this stock also. As you can see, here is Riot, and right now at the making of this video, the stock market is closed on February 9th, 2022. So if you're not watching that anytime around this, then the price will be different from what you see. But that's not the point of this video. The point of the video is to show you how to do options. So originally you can see here, I have 100 shares at an average cost of $37. So that means last year I sold a put for, I believe, around $200 in premium for a $37 strike price. And when the price dropped below that, before expiration or on expiration, then I was assigned 100 shares because I sold one put contract. So you will need to understand the difference between a call and a put. When you sell a put, you are basically saying you agree to buy 100 shares at the strike price. If the stock price goes below that strike price on the date of expiration when the markets close, you are obligated to do this. You have no choice if the stock price falls. If you buy a put, you can sell shares. You don't have to, but you can if you choose to. And then if you sell a call, then you are going to be obligated to sell 100 shares at the strike price if the stock price goes above the strike price that you chose. So you have, again, no choice. You are obligated to do this. And then if you buy a call, that means you have the option. You don't have to do it. You're not obligated to do it, but you have the option to then buy 100 shares, or you can just sell the call back if you made a profit, or if you want to cut your losses, you sell the call back. So that's the basic gist of calls and puts. So as you can see, I've already got that there. I was attempting to see about lowering my cost basis. So I sold a $17 put. I only believe I got like $25 in premium for it, but it was still a nice little bit of profit. As you can see, it expires on the 11th. So right now it has a value of 5 cents or $5. And right now the stock price is at $19.41. So it's nowhere near the $17 strike price as of the making of this video. Now that could change in the next 2 days, so I still keep an eye on it. But as of right now, I'm planning on simply letting the $17 put expire worthless, which means I get to keep all the premium and I don't have to buy another 100 shares at the $17 strike price. Now here, I sold a call at the beginning of the week for $20, which means I would be obligated to sell my 100 shares that have a $37 strike price for $20. So I don't really want to do that, and with it so close, tomorrow I will probably roll this. So what you do when you roll it is on Robinhood, you can click on the call, then view all options. So you can see here, it automatically brings up the next expiration date, which is the 11th, which is the date I chose for this. It currently has a value of 40 cents per share or $40. So in order to roll that, I would make sure I'm on buy call. And so I would select that. So I would be buying it back by paying $40. But then I want to sell another call, and I will choose the next expiration date. And so I can choose either $20 again if I want to make $112 in premium. But again, if it goes above $20, I have to sell the shares for that. I can do a $21 strike price at $73 premium. So that would give me a little bit more leeway, and I would get to keep $33, since the difference between what I'm buying the shares that call for and what I'm selling the new one for is a difference of $33. And if I really want, I can go even up to $22, and that would give me $7 profit, since that's $7 more than what I'm buying the call back for. So I can roll this tomorrow and get either $7, I can make $33, or I can even make 82 if I really want to just sell the shares, which I don't right now. I would even have the option of going 2 weeks out if I wanted to. As you can see, that gives you more options. You can go all the way up to around $23.50 strike price. So you do have more options. Just keep in mind it's hard to tell what's going to happen in the next 2 weeks. I like going on a week by week basis, but I'm not telling you how to do your own investing. This is just, if you want to do 2 weeks, you can. I don't really recommend going more than 2 weeks. But again, you can. I know some people go about 45 days out, which it works for them. It's not my style, but if that appeals to you, feel free to do it. This is not you have to do it this way, but this shows you how to roll an option. So for instance, let's say I wanted to do $22. So you can see I would get a credit of $38, which is here showing as 38 cents per share, but there's a contract which is 100 shares, hence $38. So if I were to do that, obviously during business hours, and it were to be filled, I would buy back the $20 call expiring this Friday, and I'd be selling another call for $22 expiring on the 25th, and I would pocket $38 in credit or $38 in premium, and I would get to keep that money. I wouldn't have to give it back. It's mine to keep, and I can do anything I want to with it. Another thing to keep a lookout for is you can check the delta, like anything, if you're trying to just roll it out and just to try to keep it to where you're not called away. I would look for at least a 0.3 delta. So you're looking, like if you're looking at Robinhood, you would need at least around a 70% chance of it staying out of the money. I would go higher probably myself, but that's completely up to you again. And also another thing to look at, especially in Robinhood since it's so easy on a computer, is the volume and the open interest. The volume is how many trades have gone on for this option that day, and the open interest is how many trades were attempted but were not filled. So 23 were filled, 185 were attempted but not filled. So if you want to get it filled more easily, you need to look for ones that have higher volume, and that will help you get it filled more. Like if you go up way up here, you could in theory go up to 23.5, and you have a small volume and small open interest, and it has pretty high chance of staying out of the money. So that's if you're interested in that. You wouldn't have very much profit. Again, just $7, but it is something to keep in mind. Thank you for watching, and I hope you enjoyed the video. If you did, don't forget to hit the like and subscribe button down below. It does greatly help out my channel. And I hope you enjoy learning how to roll an option for fun and profit like a pro. If you have any comments or any questions, feel free to leave them down in the comment section below, and I will answer them with my opinion. Keep in mind that that's all this is. It's for entertainment value, and it's just my opinion. But the procedures on how to roll an option are how you would do it in Robinhood, and it pretty much goes the same for any other platform you would use. I've used Tastyworks, I've used Tradier, which I'm using right now on my other account, and it works the exact same way on them. You buy back the call that you have and sell another one at a further expiration date, either at the same strike price or higher for a call, or at the same strike price and lower if you're selling a put, if you're trying to roll your put. We're diving into a strategy called the poor man's covered call, a super popular and low risk way to get started with options trading. So if you're looking to make money with options but don't have a lot of capital to start, you're in the right place. So let's break it down. First things first, what is a poor man's covered call? It's a strategy that mimics a traditional covered call, but with a lower initial cost and lower capital requirements. Typically, when you sell a covered call, you own 100 shares of the stock, and then you sell a call option on those shares. But for a poor man's covered call, you replace the 100 shares of stock with a long call option. This gives you the same exposure to the stock, but at a fraction of the price. So the long call takes the place of the normal 100 shares you have to own to sell a covered call. You're essentially buying a long call option with a longer expiration date, and then you sell a shorter term call option against it. This way, you get to keep a lot of the benefits of a traditional covered call without needing to spend thousands of dollars potentially to buy 100 shares of a particular stock. Let's break it down step by step with an example. Imagine you want to trade a stock like this one, AMD, which is currently priced at $107.62 per share. A traditional covered call would require you to buy 100 shares at $107.62, which is $10,762 in capital that you would have to tie up buying the 100 shares to start doing a covered call. That's a huge capital commitment, but with a poor man's covered call, you could instead buy a long call option with a strike price of $75, expiring almost a year from now, and this option would cost $3,950, which is still a lot of money, but it is 40% of what you would have to spend to do a traditional covered call. Now, instead of owning the 100 shares, you own this long call option here at 75, which gives you the same upside potential as owning the stock. Next, you sell a short-term call option on the same stock. Let's go ahead and take a look. So let's see for this upcoming week. I would try to sell something around the 20 to 25 delta range just to be safe. So for instance, if I were to sell a call, I would try the 113 because it has a delta of 0.18, so there's an 82% chance of profitability. So I would sell that call, and I would just keep selling calls like that every single week. So I would lower the cost basis. In this particular one, I wouldn't technically receive any premium for starting this because the $57 would be taken out of the $3,000 I'm paying for the long call. But after this week, then you could start collecting premium to earn back the money from the long option. By doing this, you're still generating income through the premium you receive for selling the short-term call, just like a traditional covered call. But instead of tying up the $10,700 to own the shares, you're only paying almost $4,000. And now you can collect premium on a fraction of the capital. It's pretty neat, huh? Now, as with any strategy, there are risks to consider before diving in. Let's go over some of the potential downsides of a poor man's covered call. First up, the long call you purchase could lose value. If the stock price doesn't move in your favor, the value of that long call option could decline, and you could lose the premium you paid for it, just like with any other option trade. If the stock price doesn't go up as expected, you might end up losing the entire amount that you paid for the long call. Second, by selling the short-term call, you're limiting your upside. If the stock price goes way above the price that you chose for your strike price on the short call, you will still be required to sell your stock at that price. So you can miss out on big gains if the stock rallies beyond that level. That's why it is essential to pick a strike price that gives you a reasonable balance between income and potential upside. Another risk is related to timing. You're selling short-term calls, so the expiration date of your sold call can catch you off guard if the stock price starts moving quickly. The shorter the time frame of the sold call means you need to pay close attention to the stock and be ready to adjust the position if things don't go your way. So, there are definitely risks involved in a poor man's covered call, but they can be managed if you understand the strategy and stay on top of your positions. Now let's talk about the benefits. There are some pretty solid advantages to using this strategy, which is why it's popular among options traders. First, the most obvious benefit is a low capital requirement. You're not tying up $10,000 plus to own 100 shares of the stock. Instead, you're only paying for the long call, which is typically much cheaper than buying the stock outright. This makes it a great strategy for people who want to get exposure to stocks without having to invest a lot of money up front, and especially if you're growing your account. Second, you can still generate income. By selling the short-term call, you're collecting premium income just like you would in a traditional covered call. This income can help offset the cost of the long call or boost your returns if the stock doesn't move much. And in the end, that's what you're trying to do with the short-term calls. You are trying to offset the cost of the long call so that by the end, about 30 to 45 days from expiration, you can sell the long call and you will have made a profit. That is the point of the poor man's covered call. Another benefit is a limited risk. The risk of a poor man's covered call is limited to the cost of the long call that you bought. Even if the stock price crashes, your loss is capped at that premium that you paid for the long call, which is far less than the potential loss from owning the 100 shares of the stock itself. Finally, there's more flexibility in managing the position. If the stock price goes up, you can roll your short call to a higher strike price and extend your position. If the stock price drops, you can decide whether to sell your long call or let it expire, giving you more control over your trades. So to wrap it up, the poor man's covered call is a fantastic strategy for traders who want to generate income with options but don't have the capital to buy 100 shares of a stock. It is lower risk, it gives you exposure to the stock's upsides and allows you to collect premium income. But just like any strategy, it comes with risk, especially if the stock doesn't move in the direction you expect, or if you're not careful about timing or paying attention to your position. Before jumping into a poor man's covered call, make sure to do your homework and understand how it works. And remember, always manage your risk carefully. Thank you for watching. I hope you enjoyed the series. And if you have any comments, feel free to leave them down in the comment section down below about your options history, any tips, any questions. Also, while you're down there, please hit the like and subscribe button. It greatly helps out my channel. And as always, happy trading.